Hello, my name's Brandon. I'm here to talk about inflation. Honestly, I've made a lot of videos about inflation. I'm sorry to keep harping on about it. I know it's not the most interesting of topics in the world, but it is pretty important to keep on top of and kind of understand what's being done about it, because that does have some implications for us as investors. So we have big inflation numbers to talk about. We also have a significant update from the Fed about tapering this stimulus quick smart, and also hiking rates next year, aka pumping the brakes on the economy. So we're going to talk about what's going on, and we're also going to finish the video by having a chat about how we as investors need to handle this information, because it's actually very important. So with that said, let's get started. This video is brought to you by ShareSite. Sick of tracking your performance manually? Track capital gains, dividends, and currency fluctuations easily, and when it comes to tax time, have everything you need ready to go with just a click of a button. Try ShareSite for free or use the referral link in the description to get 4 months free when you sign up to an annual plan. So we've seen inflation rising a lot this year. It doesn't take a genius to see that there's been a lot of, A, money printing, and B, disruptions to supply chains in many industries. And that's causing the prices of particularly goods to rise. Now, last month's data for October showed inflation came in at 6.2% for the last 12 months in the United States. And a few days ago, we got more inflation data showing we're now up to 6.8%. It's the highest inflation rate since 1982, without considering the differences in how inflation is recorded these days versus back then. And in fact, interesting point that Hamish brought up on our podcast the other day is that, if you were using the same methodology that they were using back then, our inflation rate today would actually be over 15%, which is pretty ridiculous. So that's the first bit of news, that inflation continues to rise. But the much more newsworthy story is what the Federal Reserve has decided to do about it. So I made a video a week or two ago about the Fed doing their little 180 on the current state of inflation. And in that video, we discussed how, Jerome Powell has said that the Federal Open Market Committee will likely discuss, speeding up their taper of stimulus in response to the sustained inflation. Now, fast forward a couple of weeks, and we've actually got that exact answer. So the FOMC held their December meeting, and we've got 3 big things to talk about. Number one is that the Federal Reserve has resigned to the fact that inflation is heating up. They raised their 2021 inflation expectations to 5.3% from 4.2%. Which is a bit strange, because not a week ago we got the news that from November to November inflation is up 6.8%, so not sure how they see it coming back down to 5.3%, but I guess 5.3% sounds a little bit better than 7%, so maybe there's that. And then flowing on from that, point number 2, we also have confirmation that the Fed will indeed speed up the tapering of its stimulus, the first step towards tightening monetary policy. CNBC notes, quote, "The Fed will be buying 60 billion of bonds each month starting in January, half the level prior to the November taper and 30 billion less than it had been buying in December. The Fed was tapering by 15 billion a month in November, double that in December, then will accelerate the reduction further come 2022. So what this is saying is that the Fed was providing 120 billion in stimulus per month. It's now scaled back to 60 billion in January, and they'll reduce that amount by 30 billion each month, meaning stimulus will be wrapped up by March. So exactly what the Fed said they would likely do, they actually decided to do. Stimulus will be wrapped up pretty soon. And this is important because that then opens the door to rate hikes, which is essentially taking money out of the system, putting the brakes on the economy. So they have to stop putting money into the system before they can start going the other way. And they're doing that. It's now that we get to news story number 3, the one that's making the big headlines. The Fed is going the other way. At this moment in time, their intention is to raise rates next year. but it's not as scary as it sounds. In fact, it's actually pretty weak. They're planning on raising rates 3 times, each raise being a 1/4 percentage point. Wall Street Journal writes, quote, "The Federal Reserve set the stage for a series of interest rate increases beginning next spring, completing a major policy pivot that showed much greater concern about the potential for inflation to stay high." Most central bank officials in the projections released Wednesday at the conclusion of their 2-day meeting penciled in at least 3/4 percentage point rate increases next year. Interestingly, in September, around half of those officials thought the rate increases wouldn't be warranted until 2023. So there you go. 3 rate hikes penciled in, each a 0.25% rise. But here's the thing. Is that actually going to do anything? Is an interest rate of 0.75% or 1% actually going to reduce inflation? I mean, at the end of the 1970s, inflation ran up to like 15%. When that happened, Paul Volcker upped interest rates to a peak of 20% in June of 1981. 20%! Now, of course, this wasn't super popular. You're essentially buying a house with a credit card interest rate, but it did stop inflation. It pulled it back down to 2.5%. Now, these numbers are a little bit bigger than what we're seeing right now, but it does make you think, will a 0.75% rise in rates next year actually do anything? I guess we'll see, but my inkling is probably not. But anyway, that's the news. Yes, monetary policy is shifting. The taper will speed up and rate hikes are now all but confirmed for next year. But with that said, I wanted to finish the video by just talking about what we as long-term value investors should be doing because of this. And to get straight to the point, I think the answer is nothing. I think as value investors, it's important to stay in the loop with macroeconomic events and trends, but I do not think you should use them to alter your decision making. At the end of the day, we need to stay like hyper focused on those individual businesses and not get caught up in the external stuff. And there's a few reasons for this. Number one, macroeconomic predictions don't always work out, Then number two, you as an investor, you have no control over what will happen in the macro, so why are you worrying about it? And then 3, if you're influenced by the macro, it may lead you to do counterintuitive things with your individual positions. I was actually watching a Mohnish Pabrai lecture recently, and I think he beautifully sums up how we should be thinking about the macro when it comes to our own investing. So have a listen.
I think investing is difficult enough if you're just trying to understand a business and how it works. I think when you start overlaying and trying to make assumptions, okay, here's what I think will happen to interest rates or unemployment or recession in this year or that year, all of those things most people are wrong about. Everything I thought that would happen with COVID in March 2020 turned out to be wrong. I mean, I would have never guessed that now we'd be sitting at all-time highs on the stock market after, more than 500,000 people died in the US. And we had all these lockdowns and stores and everything shut down and businesses, people working remote. I also wouldn't have thought that remote work would have led to a more productive workforce, not a less productive workforce. These are all counterintuitive. And so I think that the best thing to do is not to give too much weight and not to think too much about the macro, because it's a lot harder and it may not have an effect in the end at all.
In short, most macro predictions are wrong. Don't listen to them. Don't worry about them. Judge each business on its merits. And at the end of the day, if you're in a company where they've got a big moat, great management, and you've bought at a margin of safety price, that's 3 layers of long-term protection from the macroeconomic environment. What would be the worst outcome is selling a great business due to macroeconomic fears, only for that business to continue growing as you once predicted it would, and the stock price goes along with it, and you just get left behind. That would absolutely suck. But overall, guys, that is the latest update on the macroeconomic environment and also how it affects us as value investors. Yes, rate hikes are coming, stimulus is stopping, the market may even face a big correction next year, who knows? But for us, with our long-term mindset and our eyes on great businesses, it really won't change anything. If anything, it might just give us opportunities to buy, which at the end of the day sounds pretty good to me. So anyway, guys, that will do us for this video. I hope you enjoyed it. Leave a like on the video if you did enjoy it or if you found it useful. Subscribe to the channel if you have not done so already. Yeah, let me know what your thoughts are on the macroeconomic environment and all this stuff coming out from the Fed. What do you reckon? Do you reckon that we'll keep seeing inflation? Do you reckon 0.75% is just not enough of a hike and we'll just see it continue to race up? Will they have to increase rates by even more next year? I don't know. Let me know your opinion down in the comment section below. Thanks always to the Patreon producers for helping make this content possible. If you're interested in checking out PROFITFUL as well, links down in the description below if you wanted to learn about how I go about my investing. But guys, that will just about do me. Thanks very much for watching. I'll see you guys in the next video. Thanks again to ShareSite for sponsoring this video. So recently I finally decided to stop being lazy and I imported all of my stock portfolios across into ShareSite. Finally. I should have done that a hell of a lot sooner. So with ShareSite, you sign up, you link your ShareSite account with your stockbroker, or you just add your positions manually. And then from there, ShareSite tracks everything for you. It tracks your capital gains, it tracks your dividends, it'll track your dividend reinvestment plans, it'll track gains and losses from currency fluctuations. Seriously, this is by far the most thorough portfolio tracker I have ever seen. And because they track and record everything so thoroughly, they can provide you with all of these reports. So from literally simple performance reports to complex predicted future cash flow reports if you're a dividend investor. But here's the really good thing, they also provide all of these detailed reports for tax time. So send these reports to your accountant, done. Plug these numbers into your tax return, done. Simple as that. It's a big help. And most of these features are available for free, but to be honest, to get the best experience, I would personally bite the bullet and upgrade to a paid plan. Honestly, this is one of the few stock market related subscriptions that I would actually recommend. It's very helpful, particularly when it comes to tax time. Anyway, if you did want to sign up, simply use the referral link in the description, or you can go to sharesite.com/newmoney, and ShareSite will give you a special offer of 4 months free when you sign up to an annual plan. So at least sign up for the free plan. It will make your life easier. But that's it for today, guys. Thanks very much to ShareSite for sponsoring this content, and I'll see you guys next time.